Markets can be wild. One day everything is up, the next it all crashes. And honestly, I get why that makes people nervous, especially if you are saving for retirement or trying to grow wealth for your family. So today I want to help you build something strong, something that doesn't break when markets shake. Let us talk about how to build a resilient portfolio, especially when the world feels unpredictable. Hi there, my name is Khalid Shamim. I'm a wealth manager who works with expats and professionals across the GCC region. And in this video, I'll walk you through how to build a portfolio that survives market storms and even thrives in them. So let's start. What is a resilient portfolio? A resilient portfolio is one that holds up even when things go wrong. It doesn't panic when stocks drop. It doesn't fall apart when inflation rises. Instead, it keeps working towards your goals no matter what's happening around it. That doesn't mean it never loses value. It just means it's built to survive tough times. Because here's the truth. Market will always have ups and downs. But your money, it doesn't have to live like that. Now, why building resilience matters? Most people think investing is about chasing returns, but the real secret it's about avoiding big losses because one bad year, especially near retirement, can change everything. Markets are volatile, geopolitics, inflation, interest rates, they all play a role. So, yes, you need growth, but more than that, you need protection. So, how do you build it? Let us break it down. Now, there are three key ingredients. First is diversification. This is not just owning 10 different stocks. That's not diversification. That's just owning more risk. Real diversification means mixing assets that react differently to the same event. Like when oil prices rise, some stocks go up while others go down, or when inflation hits, bonds will struggle, but real estate could hold its ground. So don't just spread your money out, spread it wisely. Think of it like building a house. You don't only use concrete, you mix steel, concrete, and bricks. So the whole thing stands strong. Second is quality over hype. You know how some companies make headlines every week? New tech, new trends, new buzzwords, they sound exciting, but excitement rarely leads to good results. What really works are companies with strong fundamentals, clear profits, smart leadership, and long-term staying power. These are the companies that keep delivering even when the world gets messy. Not flashy, just solid, and that's exactly what you want when markets are shaky, because when the dust settles, these companies are still standing. Third, and maybe most importantly, protection matters. You don't just need growth. You want to protect your capital because once you lose money, getting back to where you started takes time. Say you invested $100,000 and it drops by 30%. Now you are at $70,000. Now to get back to your $100,000, you need a 43% returns, not just 30%. That is math most people forget. So how do you avoid that? By including investments that shield you from deep losses. Some strategies offer full capital protection, meaning even if the market crashes, you still get your original money back. It's not magic, it's maths designed to work for you, not against you. And one of the best tools I use with clients is something called structure notes. So what are structure notes? They are not something you hear about every day, and they definitely won't show up in your average finance class. But as someone who helps expats plan their wealth across the GCC, I have seen how powerful they can be, especially in uncertain markets. Now, here's what you need to know. Structure notes are financial products offered by major banks, names like JP Morgan or Goldman Sachs. And what makes them special? So here you decide how much you want to be paid, how much market exposure you want, and how much protection you need. So if you want growth potential without risking your capital, structure notes can offer that balance. And that's why I use them with clients who want resilience first and returns second. So how structure notes fit into a resilient portfolio? Let's say you have got a typical portfolio made up of stocks and bonds. When the market goes up, you win. When it crashes, you lose. That's risky, especially if you are nearing retirement. Structured notes offer something different. They let you take part in market gains while protecting you from the worst of the losses. Now here's how. Imagine a structure note tied to S&P 500 with 40% downside protection. If the market goes up by 20% over 3 years, your return might be 30%. That's better than the market. And if it drops, let's say by 20%, you still get all your money back. Because remember, you are protected up to 40%. That's the power of structure notes. You get growth potential without risking everything. Now you might be thinking, this all sounds great, but isn't this just for the ultra wealthy? Yes, that used to be true. For years, structured notes were only available to ultra high net worth investors with a minimum of $1 million or more. But things have changed. Thanks to improvement in technology and regulation, these tools are becoming accessible to more people than ever before. Not everyone has $1 million, but many professionals across the GCC now qualify for these strategies, and that's powerful. So, where do you start? Let's say you are serious about protecting your money but still want it to grow. But where do you begin? First, talk to someone who understands global markets and the opportunities available here in the GCC. Someone who knows how to balance growth with safety. Second, look at your goal. Are you saving for retirement, your child's education, or just protecting what you have already earned? Once you know that, you can build a strategy that fits. And sometimes that strategy include structure notes. They are not for everyone, but if you want to grow your money without risking everything, this could be exactly what you're looking for. Now, building a resilient portfolio isn't about timing the market. It's about staying invested without losing sleep. It's not about chasing every trend. It's about knowing what works and sticking with it. If you would like to learn more about how to build a resilience into your wealth plan, there's a link in the description below. I have put together a short guide called Structure Note for Dummies based on over 17 years of helping clients safely grow their wealth using this tool. No sales pitch, just useful information. My name is Khalid Shamim. Thank you for watching this video. If you found this helpful, hit subscribe button and I'll see you in the next one.